Well, we want to welcome everybody who's joining our Be Your Own Boss webinar here, first quarter 2021. We see people coming on. We're just going to go over a couple housekeeping items and then we will get started. Really appreciate everybody taking the time. I'm John Groppoli. I head up the franchise sales department here at Sunbelt, and I'll be introducing my colleague, Chris Jones, who's the president of Sunbelt Business Advisors here in the Midwest. He and I have been doing these seminars and webinars for probably over 10 years now. And we like doing about one each quarter. And the theme is really to get educated, to help educate you, the buyer, on the process of purchasing existing businesses. Some of you might be active reviewing businesses that we have for sale or other groups. And some of you might be just dipping your toe in the water and starting to figure out, hey, could business ownership be for me? So we really get excited about educating the buyers and helping them understand if business ownership, entrepreneurship is for you. Just a couple again housekeeping items before we start is for questions. We want to make this interactive. We love getting questions from the attendees, and so you'll notice that there's a Q&A button on the bottom of your screen, and we ask that if you have questions, just click on that button, enter it into a Q&A, and Chris or myself will address that as we go through the presentation. So to start, I've got a couple quotes here from Nolan Bushnell and Elon Musk. A couple of our favorites, that a true entrepreneur is a doer, not a dreamer. I could either watch it happen or be a part of it. And business ownership is not necessarily for everybody, but business owners are doers. They're not dreamers. They're doers, and it's a perfect theme for this start of this webinar, because a lot of people think about business ownership at some point in their lives, but very few people take the time and the effort to get educated and roll up their sleeves a little bit and see if this could be for them. So again, we respect and appreciate you taking some time with us this evening to learn a little bit about this process. The state of the state in terms of with COVID and what we've seen over the course of the last year now, this is an appropriate slide to start with, because as you are starting to take a look at businesses, or maybe you have been looking at businesses for a while now, it's a good time. We went through a period, I think Chris would agree, March through June, July of last year, it was very slow for us. And in terms of buyers out there looking at business listings, it was slow. But fourth quarter 2020 to first quarter of 2021 here, our volume of buyers and our activity of buyers has really increased. And that could be for a number of reasons. It could be individuals who are been working at home, having a little bit more time to investigate opportunities, thinking that they like the flexibility and maybe they want to take control of their lives, and instead of working for somebody, get into business ownership for themselves. But there's also some reasons on the financial side, and this slide highlights a few of those that you look at the commercial real estate arena, and we've had a reset with that, because unfortunately there have been businesses that were not able to make it through COVID. They were more sensitive to COVID. And so you have opportunities from a real estate location, number of locations to compare if a business requires that. Also from a lending standpoint, a lot of buyers don't realize that currently, and this is until the funds run out or the end of September, that if you were to take out an SBA loan, that the SBA is going to pay the first 3 months up to $9,000 of your P&A payments for that particular loan. And that's not a deferment. They're actually making the payments for you for those first 3 months. The SBA guarantee fee is also waived until the end of September. And that can be substantial depending on the size of the loan that a buyer, an investor might be looking to take out. And also, what we're seeing from the lenders are aggressive right now. And part of the reason they're able to be aggressive looking to fund business transactions for buyers is the SBA has come in and they've increased their guarantee back to protect that lender from 75% to 90%. So it really reduces the risk for the lenders. Thus, they can be a lot more aggressive talking to individuals like yourself out there who might be interested in business transactions. Low interest rates, employee pool. At the end of the day, individuals who are starting their own business or are looking to hire, there's been an increase to that employee pool. Some individuals got let go, got laid off during the last year. And then we also have a motivated government that continues to put money into the economy to keep it going and to really boost and encourage small businesses to continue to grow and hire back employees and open up new businesses. So this is a good time. This is a good time for you to get educated and see if this might be the right opportunity as you go down your journey. And so with that, I'm gonna pass the baton to my colleague Chris, and Chris is gonna walk us through the process of purchasing an existing business. And then we're going to come back and I'm going to spend a few minutes talking about the process of purchasing a franchise license. And then we're going to wrap up the evening by going over just a couple franchise opportunities, spotlighting a couple models that have shown recession resistancy. And through feedback over the years, people have always told us, hey, we'd like to hear about some opportunities in the local marketplace. And so we're going to end the evening with regards to that. So I'm going to pass the baton, Chris.
Okay, thanks, John. We are very high tech around here tonight. We are using one laptop because we don't want to take a risk that we had issues. So we are going to be sliding in and out just to make sure it works well for our audience out there. And again, thank you for joining us. My name is Chris Jones. I'm the president of Sunbelt Business Advisors of Minneapolis. And what John and I are going to do tonight is divide up the work. And I'm going to talk about buying an existing business. He's going to talk primarily about buying a franchise. And as he touched on, we're not trying to convince you to do either one. We're trying to equip you with tools so that you can comparison shop, if you will, understand the pros and cons of each, and then be able to go in as an informed buyer and understand what works best for you. So I'm going to kick things off with talking about buying an existing business. And I want to give you some big picture observations first. What you should be seeing on your screen right now is a 2020 data on small businesses in the United States. And what's great is if you go back and look at the 18 report, and I think the 19 report too, the number of small businesses has actually increased despite all the challenges we had as a country and the world had with COVID. And small businesses still make up 99.9% of businesses out there. And they employ, according to this latest data, 47% of the workforce. So big companies do have a lot of employees, but small companies continue to be a huge part of our economy, almost 50%. And I think that's pretty cool. It shows that small business still remains very relevant and weathers a lot of storms. The other data you'll see here is now drilling into Minnesota. We may have participants from other states, but we're broadcasting from our Minneapolis office, so we're going to share some Minnesota data. And you can see on the screen here, 526,350 small businesses in Minnesota. And again, about 47% of Minnesota employees work for small companies. Now, on the surface, that means that 28% of people, of households in Minnesota, own a business. And although that's true, we're going to boil it down a little bit more and look at those companies that actually have employees versus folks who are self-employed. And if we drill into this data a little bit more, it's useful to see, if you throw out the non-employer firms, which you see on this next slide here, is over 400,000 of those, it's over 400,000 of those over 500,000 businesses. So most have no employees. The folks we're going to talk about tonight that we refer to as Main Street companies are these on the left with under 20 employees, and they account for 101,000. Now this is an older table, but it's very similar. So we're going to talk about these kind of companies tonight. Having your own company where you have no employees is a very legitimate way to be your own boss. As you can see, many people do that. And we actually sell some companies that have no employees, especially with technology, but most of them do. So we're going to focus there tonight and talk about folks that have employees. And what's kind of cool about that number, that 101,000 that you see here and 120 employees, that means that still 5% of folks in Minnesota own a company with employees in that size range. And then you have this huge population, of course, that own companies without employees. Okay, so hopefully that makes sense to you. What we encourage you to think about when you think about should you join that percentage of folks that are a small percentage of Minnesota and US population is stop and ask yourself some questions. What is your motivation? Why do you want to do it? Is it strictly for being your own boss? Do you want to get out of the corporate life? Maybe you're looking to build value with that because you can't, nobody's going to buy your job in the future, and a business they can buy from you years from now. You can build value just like you do in real estate. We also encourage you to ask, are you willing to take risk? Most people that you're going to talk to, especially accountants and attorneys, will tell you to not buy a business or franchise. Why? Because there is risk. There's just no way around that. Owning a business has risk. Owning a franchise has risk. Doing nothing also has risk. So, but there is no way to go at this, or really any investment, without taking some risk. And businesses generally have better returns, but they also have more risk than, say, a passive investment in stocks and bonds. Then, of course, do you have the financial resources? Do you have the capital it takes to acquire a business in the first place? And are you realistic with how much buying power you have, with how much income you need? Before you leave that corporate job or whatever you're doing now for income, do you have the money it takes, and can you afford to buy a big enough business that will support the lifestyle you want? Or if you're a strategic buyer, do you have the resources to buy the size company you want to add on to your company? In any event, you have to take stock of your resources. So start by asking yourself some questions. And then one of the additional questions you might want to ask yourself is, why would I buy an existing business in the first place? And the answer is probably obvious to a lot of you, but we're just going to touch on it. Obviously, you have immediate revenue and cash flow versus a startup company. You have proven products and services. In many cases, ones that have been honed over time by the current ownership, or maybe even several owners who have grown it from 0 to $500,000 in sales to $1 million in sales. And they've made a bunch of mistakes. They've also done a lot of things successfully and figured out how to develop a market of a proven product or service. Of course, with that comes a brand, trained employees, vendor relationships. And then this one's often underrated by folks who are buying their first business, but current business owners know how important it is. Training and transition from the current owner and the institutional knowledge of that business that it has, that it knows how to do business. That's sometimes referred to as goodwill. That can be the relationships with the customers and those vendors, but it's also just employee know-how. They're experts at what they do. And that is a better way to make profit, typically. Then, of course, control for you as an owner, financial reward, and as I referenced briefly earlier, building long-term equity. As the business is paying you each month or each year from profits, you also are building value in equity, because someday you will likely sell that company as well. So you're able to build long-term equity as well. We have some buyers we work with. One that I can think of is just purchased their 7th or 8th business, and they hold several, but they typically build them, get them to a certain level where they're comfortable with the size, and then they sell it off. Some folks only buy one business. That's very common, but some buy multiple because they know how powerful it can be to build equity in a business. Again, much like real estate. So if you ask yourself those questions, do I have the resources? Why am I doing this? Kind of what's your why? And then, is it an existing business? How do you find the right fit for you? Because there's many different types of businesses you could acquire. What I would suggest you do is take an inventory of your resources, your financial resources we've touched on, but then also your experience and skills, and say, what kind of businesses would that complement? What kind of business needs what you have? So you obviously need capital to acquire that business, and often capital to grow it beyond its current size, but you may have some significant skills that you can bring to a business in sales and marketing, operations and logistics, technology. We're seeing a lot of folks buying retail companies now that don't really have an e-commerce strategy, and younger buyers are coming in, or more folks with more experience in e-com are coming in and fixing that problem. So that might be a skill you have, where you can take a somewhat tired business and come in and fix some of the problems that maybe the current owner doesn't have the skills to fix, or just doesn't have the energy to fix, because they're often looking to retire. They've gotten comfortable, the business pays them enough, and they're not looking to really drive it to another level. They're not looking to invest in that technology or hire the next sales manager. So take an inventory of those resources and say, what do I bring to the table? The other thing I want to touch on as you're selecting a business is you need it to do three things for you. The earnings of the business must do three things for you. So this can help you eliminate some companies that don't do these three things. And we've been doing these Be Your Own Boss events for years. And this is one of the things I encourage our audience to say. If there's one thing you remember, I mean, obviously you remember all of John's slides, but after his, remember this one. The earnings of the business must do three things for you. It must pay whatever your minimum salary needs are if you're going to be an owner operator, right? It has to support whatever your lifestyle is. You know, realistically, it's got to pay you. It also needs to service the acquisition debt. So if you're using an SBA loan or some other type of loan, and we'll touch on those instruments later, it obviously needs to service the debt. But it also should have some cushion, some money left over after it pays you and it pays the debt, to allow for working capital, CapEx, and investment back in the business to drive growth. Most banks that you talk to, although they call it debt service coverage ratio, like to see that cushion or coverage ratio of at least 20%, sometimes more like 25%. If they're really conservative, they might want an extra 30% left over as that cushion. But if you're looking at a business and it can only pay your salary and the debt, and there's no money left over, chances are that's not a deal you should do. We have a finance director who, if you're looking at a deal with us, can help you with that analysis. Any bank you're working with, if you're working with your own bank, should be doing that analysis with you. Or even if you're doing seller financing, do the math, and based on historical financials, will it achieve these things? All right, so I hope that makes sense. We're going to try not to get too technical in accounting stuff tonight. This is more conceptual and educational. Okay, so now that being said, this is probably the most complicated, these next couple slides we're going to get on defining financial terms. As you start looking at companies, or if you have been looking at companies for a while, you're going to find out that it can be difficult to determine the earning power of a small business or even a mid-sized business. It can even be difficult to determine the earning power of a public company, depending which books you're looking at, the ones they publish to the marketplace or their actual detailed books. This is especially true in small companies that are private and don't have to report to a public market, because they are doing their taxes to not pay taxes, looking for every legal way they can to show expenses or deductions to get their tax bill down. So the net income on the tax return almost never tells the whole story. One of the terms we look at the true earning power of a business is called seller's discretionary earnings, or SDE. And what SDE is obviously the net income of the business, but also adding back expenses that you will see on the tax return or P&L, such as depreciation and amortization. Nobody ever writes a check to those accounts. They are a non-cash charge. Interest expense, because the business owner is going to deliver the business typically free of all liens and encumbrances. The owner's salary, because unless you folks are really generous as buyers, you probably, if you're becoming an owner operator, you're not going to keep that owner around. They're retiring. You're stepping in and taking over their roles. The owner's salary is gone, as is their discretionary benefits. So they've been running their car payment through the business and expensing it. If they've been running 401k through, if they've been running other expenses like that, or other discretionary benefits like Vikings tickets, travel, and expensing it, and it's a non-operating expense, chances are that should be added back. All subject to your verification and due diligence, but if they aren't expenses that are necessary to operate the business, they likely should be added back. And that's going to tell you the true earning power of the business. Now, I want to be clear, that is on a pre-tax basis, okay? That's before taxes. It's telling you the earning power, and everybody has different tax scenarios. So that's something you have to assess, that those are the gross earning power of the business on a pre-tax basis, okay? So I'm going to give you an example of how important this is. And you should be seeing a slide right now that says SDE allows for an apples to apples comparison of the earning power of a business. And again, SDE stands for sellers discretionary earnings. So if we were to look at two companies, example one, example two here, company one, company two, and we just look at their tax return, what we see, we go down to the net income line, is company one shows net income of 100,000. Okay. Company two, net income of 0. So if I stopped right there and said, well, that's what they make. That's what the tax return says. So that must be what they make. I would look at, why would I ever buy company two? It doesn't look like it makes any money, but it's mysterious to me because the owner tells me they've been running it 20 years. They live in a nice home, driving a nice car. Their kids have gone to good colleges. How are they affording this lifestyle of this business? So I dig a little bit deeper. And what I see is I find out that owner in company one takes a salary of 100,000 and depreciation of 50,000, which again is a non-cash charge. It's not a real expense. It's for tax purposes. They aren't paying any interest, not running any perks through, but I can look at that and I can take that net income of 100,000, add back the salary of 100,000 the owner's taking, and the 50,000 of depreciation. And if you're following along, we have 250,000 of SDE. Okay. Now I look at company number two that has net income of 0, but wow, look at this. The owner, this is one owner, takes a salary of 300,000. They're paying themselves very well. Depreciation of 50,000, 0 interest, but they're also running through 50,000 in perks, whatever those are, automotive, life insurance, etc. Expenses that you won't have as a buyer post-closing. So I add those numbers up, and now I'm talking 0 in net income, plus 300,000, plus depreciation of 50,000, plus 50,000 in perks. And I now have a company two that's making 400,000 in true earning power of that business. So this is a very simple example, but if you don't go beyond the net income line, you are not, and don't ask these questions, and don't ask about things that may need to be added back, you're going to have a tough time finding a company unless you uncover these things. Typically, when you're working with a business broker, they should give you a worksheet that shows these. You should still verify those. Most owners can answer these for you too, but a broker, if they're working with a broker, they can help organize that and give you a worksheet that shows these totals. And most web ads for businesses for sale will contain this number. So now that we know the earning power of that business, we have to figure out what that means to the value of the company. Most companies sell for a multiple of that SDE number. Our two most recent examples, we had the one that company one had 250,000 in SDE, company two, 400. So we know their earning power, but we really still don't know what they're worth. So what are you really buying? You're buying the future or the likely future of that company. The 250,000 they made last year in company one, or the 400,000 they made in company two, you can't get that money. It's a good indicator of what the company will make the next year because it's the most recent trend, but it's not guaranteed that they're going to make that again. So there's a lot of things you need to do to look to the future. But one of the biggest questions, simple questions you can ask is, how likely is it that the revenues and the earning power of that company, the SDE, will continue into the future, right? And that can help you determine not only a multiple, but how much risk there might be in the business or how much growth opportunity there might be in the business. I hope that makes sense. And there's a really wide range of multiples out in the marketplace. We typically see between 2 and 5 times for small Main Street companies. If you get past 20 employees or in a higher cash flowing business, you will certainly see multiples past that. but they tend to be much larger companies or folks with consumer products or intellectual property, or businesses that have scaled up a little more. Most companies that we're selling that are Main Street are 2 to 5 times the STE number. That's still an enormous range. And some of that depends on the size of the company, the industry it's in, but primarily it all comes down to risk and growth. The riskier companies get lower multiples. The companies with less risk and more growth opportunity, like big growing industries like e-commerce, get higher multiples because they're just more attractive and less risky. So here's a slide you can use to assess that a little bit. The up arrow items like growing industry, proprietary products, a great brand, IP, diversified customers, consistent revenues and earnings, that aren't spiking all over the place, but are either steady or increasing, or if they're really growing fast, it can really drive the multiple higher. That's going to get you that high multiple versus some of these down arrow items you see are going to push the price down. And as an example, you might only see 2 or 3 multiple on a small retailer with low barriers to entry because they're just riskier. They're exposed to things like Amazon and changing marketplaces and disruption in retail. And maybe they're not going to fetch as good of a price as, say, an e-commerce business that has growing revenue and earnings, and the future revenue and earnings are much more likely because they're in a more favorable industry. Also, things like big customer concentrations can hurt the multiples. Or if the business is really owner-centric, you need to look closely at that and say, can I step into the owner's role? Or is there somebody that I could promote to that role? Because if that owner has most of the relationships and you don't have the skills they have, you better have somebody on the team who does. So that's risk and could hurt the value as well. One of the clients we're getting or questions we're getting right now is, do major economic events like, I don't know, COVID, hurt multiples? And they really don't. They do affect sale prices though. This is a post from Darren Mize. He's at GCF Valuation, and he posted this probably over a year ago. But what it shows is historically that the multiples, even in times like 2008, stay pretty steady. You can see a average multiple of 2.9, 2.9, 2.8, 2.9, 2.8. And then when it dropped, it only dropped to 2.6. So not a lot of volatility. But if a company's earnings go down, of course, if their earnings go down by $100,000 and they're selling for a multiple of 3, that could cost them $300,000 on their price. So although multiples might not go down, if a business suffers during a time like COVID, certainly its price could go down if it's not recovering from COVID. And just a quick note on that too. What we're seeing from the banks is that they want to see about 3 months, I'd say a minimum of 3 months from a positive trend coming out of COVID effect before they're willing to believe there's a trend back. We're seeing a lot of good recovery, especially in essential businesses in that respect. So be careful I would advise you to be careful, or at least suggest to be careful when you make offers. Don't ignore the fact that March, April, and May were likely one-time events in that business. Chances are it's like they were hit by a hurricane. So if the trend since, say, July up through first quarter of this year has been back on track, it's difficult to make the case to a seller that that hurricane they were hit by with COVID is the new future. Now, if you can show it is, right? Well, have that conversation. If they're in an industry that hasn't recovered from it, if they're tied to the airline industry or something like that, or other types of travel, and there is no foreseeable recovery from that, in your opinion, have that conversation with the owner, because that might be the new future of that business. I'm just going to stop for a second, just take a quick look at the Q&A. We had a question about what technically constitutes a small business versus large. Hopefully I answered that earlier. For us, at least, that 20 employees, under 20 employees is what we consider a small business. I believe the US government considers 500 or less employees a small business. But that's how they look at things. That's small to them, I guess. But most small businesses we deal with are 20, maybe up to 50, and we consider them to be lower middle market if they're over 5 million in revenue, over 50 employees. So I hope that helps answer your question, Brian. And let me jump back to the slides. Then I'll take another question here in a second. Okay, so let's talk about terms. Let's say you looked at, I'm just going to use an example, that company 2 we looked at, and they're generating 400,000 in STE, and you research the industry or talk to the broker and determine that a 4-time multiple is typical for that business. And just using that as an example, that's a $1.6 million price. Just to give you guys a real example of price. Then, so that's price. If you determine that's a fair price, then there's also the question of terms. Most sellers want to be cashed out because they're worried about being paid later. They typically have some debt to be paid off, and who doesn't want to be cashed out? That being said, seller financing is very common, and don't be shy necessarily about asking about that with a broker or a seller to see if they're willing to do it, because they may be willing to take some deferred payments over time if you can prove that you are a good credit risk as a buyer. And where I see buyers sometimes making a mistake there is they show up at that meeting only expecting the seller of the company to kind of try out and impress them. Especially if you're going to ask for seller financing, you need to show why you're the right buyer for the business. Sometimes even sellers who are getting cashed out might be getting multiple offers. So it's always a good idea to explain to them why you're a great buyer for the business, not only from a credit risk standpoint, but if you're cashing them out, say, look, I've already talked to a bank. If you have, I've already been pre-approved for some financing. I already have, access to this capital. Show why you're a good buyer who is likely to close. You have a much better chance of your offer being accepted if you make one. But if you do decide to ask for some seller financing, 10% is very common. Banks like to see that. So in a $1.6 million deal, you might ask a seller to carry $160,000, and then between your money and the bank's money, you're coming in for the rest. You certainly can ask for more, and sometimes even companies sell for just the buyer's cash and seller financing. That happens too, especially in more creative deals. Here's an example of what we see in SBA versus seller financing. So if you were going the SBA route, you can assume that they're going to want 20% buyer equity. That can get lower depending on how strong you are. And the bank might do a loan for 70% and the seller carrying 10%. So as an example, on $1 million deal, if you were going to do $1 million purchase price, you're probably going to need to have about 200,000 of your own cash to put in that deal. In a seller finance deal, you generally don't have as much leverage because you're not bringing as much cash to the seller at close. We see deals that are anywhere from 30 to 50% cash at closing. So in $1 million deal, that might mean you have to do 300,000 to 500,000 of your own cash, and the balance is financed by the seller with no bank financing. Less leverage, but there are some benefits there in that your bank's the seller, and they're probably easier to work with than, say, Wells Fargo, right? You got an individual that sold you the business, and if they are willing to do that much seller financing, they definitely believe in you, and they definitely believe in the future of the company. So there are definite benefits to that. Sources of capital is a common question we get. And I'm going to actually pause for a second before I get there, because I just got a really good question asking us to talk, since we were talking about terms, to talk about how much working capital is included in the deal. So a good way to think about deals is it's a three-legged stool. There's price, there's terms, there's taxes. Those always have to be considered. Working capital is a type of term, the term of what do you get in the price. Typically in small business sales, the under 20 employee deals, even the up to 50 employee deals, often working capital will be excluded and it's replaced as part of the bank loan. And when I say working capital, I'm talking about generally accounts receivable, inventory if they have it, less accounts payable. If you do a deal where working capital is included, it means you're stepping in that business day one and the seller has left some of their accounts receivable in the business, fuel in the tank. So you've got dollars coming in day one, but it's much more common on small business sales that that's not included, and that you have working capital through the SBA loan or other type of conventional loan from day one. The seller takes any cash that's in the bank, that's money they already earned. They take the AR with them because it's products they already sold, it's, money the company already made, they're just waiting to be paid. But they also pay off all the payables. They pay off any debt there is. The business is delivered to you without any debts except the debt you bring in to buy it. So that's typical on working capital. If it's a larger business, then working capital might be included, and it's generally figured out based on kind of an average what the business has, what does it need to operate so that it can operate on a normal basis for the buyer. The working capital is not too high and it's not too low. So another question I got, this is a good one. The businesses I see for sale have both purchase price and cash flow. How does cash flow factor into the SDE? I should have touched on this already. Cash flow is just another term for SDE. So you'll hear it called seller's discretionary earnings, just DE, and cash flow. All right. Those are all terms for the same thing. So anytime you see cash flow, I think even on our site, it says cash flow. That is a term for what the earning power is of the business after it pays all its normal operating expenses, after it pays its payroll, rent, everything it needs to operate, what's left over for profit. It's just another term for that. Thank you for that question, by the way. That was a good one. Okay, jumping back to the slides so I don't take all of John's time. Sources of capital. Cash, of course, is the one obvious source of capital. Home equity, we are seeing that come back. It was scarce for a while, especially after 2008. But now we're seeing that bounce back and seeing more buyers look to home equity as a way to put more cash into their deals. Securities, more and more folks are pulling money out of the stock market to put into a business, a closely held investment that they feel they have more control on. So that's another source. And then one that's often not known very well is 401k rollovers. And there are some very attractive programs out there that allow you to take your 401k, roll it over without tax penalty in a qualifying plan. You need to make sure you're talking to the right people, but you can avoid that tax if you're putting the money into a qualified business. We have, again, folks on staff that can help with that, including our director of finance, who also, of course, helps with loans. So using the SBA, of course, as source of capital is very common in the Small Business Administration. And as we talked about earlier, sellers. Sellers financing the deals. If the seller really likes you and thinks you're a good credit risk, they might be willing to finance a good portion of the deal if they think your price is reasonable and, again, that you've got the right transferable skills and ability to run that business. So I want to touch briefly on, and try to move this screen, taking the first step. We've talked a little bit on some tools you can use to decide if business ownership is right for you. What I suggest to you, if you haven't met with a business broker before, do it. Sellers pay our fees, okay? You don't pay fees to the broker unless you hire them to go out and do a search of the marketplace. And usually we only do that for companies anyway versus individuals. So the seller's paying us, much like they pay a commercial real estate agent to sell their building. Meet with the broker, tell them your personal and financial goals. Take an inventory of your resources like we talked about. How much money do you have to invest? What transferable skills do you have? What are you good at that you can bring to a business? And then most importantly, look at some companies. Sign some confidentiality agreements, talk to a broker, have them show you the profiles. And if you see something you like, go meet with the owner and understand what they do to run the business and if it's a good fit for you. There's really no replacement for that, going and actually looking at a business. The other thing I would suggest is when you inquire about one business, whether it's with us or another broker, ask the broker if there's two other things they can show you that might be a fit for your criteria. And after you look at 3, rank them 1, 2, 3. And then after you do that, go meet with the seller at number 1, right? You're going to learn so much through that process. Don't obviously do it if you're not interested. But what that will do for you is give you a system for looking at companies, and it will allow you to compare. Like, I like this about this company, but I didn't like that. I saw this in one company that I saw was risk, but I really like the growth opportunity. And you'll start understanding where you can bring some resources to bear. You'll start understanding how that deal can get financed, and you might just find a great business while you're at it. The other thing I'm going to mention, for those of you who may have been looking for a while, you know right now that really good businesses that are coming to market are getting offers fast. And if you just started looking, you're going to find that out. So if you're looking for a way to look at more deal flow sooner, we did start a program, gosh, I think it was just early last year, I think. We beta tested it, and we've now launched it live. And it's a subscription program where you can sign up to get early alerts of businesses coming to market. It's called Inside Track. We put the website there. What we're finding is that folks who join Inside Track are 6 times more likely to find and purchase a business, because there's just so many more buyers than our sellers. And buyers have good taste. They're looking for certain things, so they tend to really come hard after good businesses. So there's a big advantage of getting early notices. So I would encourage you to check that out too, especially if you've been looking for a while and been maybe a little frustrated in finding good businesses soon enough to make an offer before they're off the market. That being said, we have had some more questions here, and I'm just going to check these. We got another question that says, can you get somewhat pre-qualified with a lender or the SBA prior to finding a business to purchase? You can. However, what you're going to find, and you definitely should try, what you're going to find is most SBA lenders especially don't really want to talk to you until you have a deal, because it's all kind of, it's all speculation, because it's about financing you and it's financing a business. That's what they're underwriting. So until you have a specific business they can look at with its financials, it's really hard for them to tell you that you'd be qualified, but they can give you an idea of what you can probably afford, but so can a broker. So I encourage you to talk to SBA lenders, get some of that feedback, but you might find that they're not willing to be real specific until you have a specific business. You can bring them something you're looking at and say, what might you be able to finance this deal for? Most of our deals that are SBA financeable or otherwise bank financeable will have a term sheet either in the business profile that you get after you sign a confidentiality agreement, or there'll be one available. Just ask the broker about that. Say, is SBA financing available? And a broker can really walk you through to what you can probably afford. Again, using some of those ratios we talked about earlier. That was a really good question. Thank you for asking that. Okay, so I've been hogging John's time. I'm going to just pop over and then we'll hand it off to talk about franchises. John?
Thanks, Chris. As Chris was mentioning, it's an interactive process, and we encourage you to meet with a broker. If you have some interest to learn a little bit more about possible franchise opportunities, you can meet with a franchise consultant. But be able to ask questions, sit down with sellers. You can learn a lot. You become more comfortable, and obviously you see what's out there as opportunities. So with that said, we're going to switch gears and spend just a few minutes on the franchise world. The reason we do this in conjunction is, through the years, we've had buyers who come in thinking that they're interested in purchasing an existing business, and they end up finding a franchise model that really fits their skill set, their passions, and vice versa. And so, we've really found in talking to lots of buyers that, they don't know what they don't know initially, and it comes down to finding the right fit for each and every one of you. And sometimes that could come through an existing business that's listed, or it could come from purchasing a franchise opportunity and a franchise license. So some of the logos on this screen, I'm sure you're familiar with, maybe brands that are well recognized, and there are others that you've never heard of before. So let's talk about a franchise. By definition, a franchise business is going to do a couple things. They're going to allow you to use their trade name. Okay. So you're going to have goods or services that are offered underneath that trademark of that franchisor. Franchisor is the corporation. That's the corporate partner. Franchisee is the individual owner of individual or multiple locations underneath the ZOR. They're going to share an operational method with you to expedite your ramp up. So increase your ramp up, get you with the goal of increasing revenue faster, lessen the mistakes that an individual might make as they get into business ownership. So they're going to show you their secret sauce per se. Provide an exclusive territory. So these franchise companies are typically going to carve out an exclusive area for that franchisee to market their business and provide a product or service in that area. Could be zip codes, could be based off of population, but you're going to have some sort of an exclusive territory that's yours. And then franchises will collect some sort of an ongoing fee, probably familiar with the term royalty fee. That could be a percentage of gross revenue. It could also be a flat monthly fee. Usually it's a percentage, but some franchisors do just have a flat monthly fee that they collect from their franchisees. When you think of the franchise industry, this slide just shows how diverse the categories are and opportunities are in the space. When I sit down with buyers and I ask them to name, maybe 5 or 10 different franchise offerings, it's pretty consistent that most buyers are going to give feedback on the food, restaurant, quick service restaurant type sector, maybe some automotive, repair type shops will come into play. But the reality is, in this pie chart shows you that, there really are opportunities in lots of different sectors. And if you've thought of an industry, the reality is there's probably a franchise opportunity out there right now servicing and in that space. So why look at franchises as you're taking a look at and just trying to find the right fit? Why should you keep the options open, keep that door open and not close it when you hear the word franchise? Well, you want to reduce your risk. Purchasing a franchise license is one of the ways that you can reduce risk. And with that, you're given that path, you're given the products and services, you're given the roadmap of how to run this business and how to ramp it up. The franchisor is sharing their best practices with you as a franchisee. And so it reduces your risk. It minimizes the mistakes. Mistakes are costly. Anybody who's tried to start their own business from scratch probably would nod their head and agree with that. That mistakes can be very costly for business owners as they try to launch their new business. So you've got a sharing of best practices. When it comes to selling a franchise business, they have the opportunity to command slightly higher multiples from an exit strategy standpoint. And the reason being is some of the things that Chris talked about in terms of keeping a seller on board or looking at the training that a seller can provide to you, the new business owner. Well, not only do you have a seller of the franchise business, but you also have all of that back end support from the franchisor that are going to train you, going to offer you ongoing support as you take over that operation moving forward. And then finance options available to buyers. A lot of individuals might not know that there are, in many cases, really, that it can be easier to get an SBA loan for opening up a new territory than in some cases purchasing an existing business. If the existing business is successfully cash flowing, then financing through a lender is most likely going to be on the table for you to consider and take advantage of. If it's a business that has been struggling, that might not be on the table for you. But with regards to, we're seeing these lenders who are looking for 10 to 20% equity down into a total project cost of opening up a new franchise and then doing an SBA loan for the balance. And that tagline of in business for yourself, but not by yourself is so important. When you're in business ownership and you look at with COVID in the last year. How nice is it to be able to support each other, bounce questions, concerns off of other franchise owners within your network, trying to navigate these waters for the first time. Quality franchise models are going to do three things for their franchisees. They're going to give you a good proven system and model for you to follow. They're going to train you well. We talked about, and we've mentioned a number of times this evening, about being trained in on that new business. Well, a franchise system is going to train you in and give you a good foundation for the business that you're entering in. And then they're going to offer you ongoing support. And that, that's key. Obviously, you're paying an ongoing royalty fee to that franchisor. And so you want to make sure that they are offering that support ongoing. The good models do these three very well. And as you start to dig into a possible franchise system, you want to ask some questions that center around these three pillars to get comfortable or not get comfortable if they actually fulfill those. When you look at investment options in the franchising world, the other reason that people invest into franchise opportunities is there's some different options out there for you to look at. You have individuals who may purchase a single territory, single license, multiple licenses, area development licenses for small, maybe tertiary markets where you would go in and you would own the market and you would open up and own multiple locations within that marketplace. So that's an area development license. You are owning each of those locations. The salon industry has always awarded area development licenses for some areas where one person comes in, they own the market, and then they open up multiple salon type locations, like a Great Clips as an example, or a Fantastic Sam's. Then the last is a regional development or a master license. That model is somebody comes in and they purchase the rights to usually an entire state. And then they may open up one location that they own and operate, but then they have the ability to sub-franchise. So then they have the opportunity where they can talk to other business owners and investors who are interested in opening up locations for that particular franchise model. And they act as an additional layer of support for that model. And in doing so, that master franchise developer, they share in not only the franchise fee when a person initially purchases the franchise, but they also get to share in that royalty stream with the franchisor. So it could be maybe a 50-50 split of that royalty. If it's a 6% royalty, 3 goes to that local regional developer, 3 goes to the franchisor. Maybe it's a 60-40 split, but it's a great way to build a much larger scale operation, build the empire where you almost become a mini franchisor in your particular state. And through the years, we've had the opportunity of working with lots of buyers and investors who did find a regional development license to invest into. And then it's a nice relationship going forward because we can continue to help that individual, grow that territory, grow their marketplace as they develop that region. Executive and semi-absentee opportunities. The reason I include this slide is for some of you out there on the call this evening, maybe you're in a situation where you've got a good job. Maybe you've been working from home more so in the last year. You have more free time, more flexible type schedule. Well, the franchise world would allow for semi-absentee ownerships with some of these different industries, not all of them, but some of these different industries will offer semi-absentee options for you to consider. And now you're in a situation where you can keep your current job, but at the same time, maybe you can find one of these franchise models that allow you to do that, but build some equity into a business as well. And maybe the goal is, down the road where you would exit that job and you would devote full time and attention to that particular business. And maybe we've had a number of individuals who do that once they've opened up 2 or 3 franchise locations that they would that they would at that point maybe leave their corporate job. So we do have semi-absentee opportunities in health and wellness industries, listed off a few here for you, as well as automotive, office workspace, portable storage, just as an example. And these are just to get you thinking of opportunities that maybe you didn't when you heard the word franchise, but just know that there are executive semi-absentee options in those spaces to keep in mind. Just taking a minute here to see. I had a question that came in with regards to selling a franchise. And it's a great question. Do you have the ability, is it doable? Do you have the ability to grow it and sell that business after 5 years or 10 years was the specific question. And yes, absolutely. When you purchase a franchise license, the agreement is typically going to be for just that. It's going to be typically for a 5 or 10 years. Usually it's a 10-year term. And then the agreement will, in most cases, not all, but in most cases, that agreement will renew for an additional 10-year term, as long as obviously you've met the guidelines, minimums, you're in good stature with regards to that franchise. That agreement will renew after that 5-year type period. Now, if let's say you're in year 4 in a 10-year term, and you're looking to sell that business, absolutely you have the opportunity to sell that business. And that new buyer who comes in, they would sign a brand new franchise agreement, and they would get that initial 10 years from the time that they purchase that agreement moving forward. Good question. So when you look at the franchising world, and I touched on this, is that there's 3,500 plus different franchisors that are out there. So, where the heck do you start? I mean, it can be an overwhelming process. So where do you start? Well, you do have an opportunity to sit down with franchise consultants, and we as franchise consultants can really help you narrow the list of models and opportunities down that really fit your criteria as a buyer. Taking a look at your income goals, taking a look at your lifestyle goals, your interests, your investment level. So we sit down and talk to individuals and uncover and discuss their criteria before we start presenting actual franchise opportunities that would meet that criteria, so that you're not wasting time. If you're qualified for a $300,000 house, you don't want your realtor showing houses that are 400,000 plus. So we take a look at all of your criteria, and then we really spend time talking about models that would meet that criteria. And then we help you navigate the process, the exploration process with these franchise models. And what that really looks like is after you talk to a franchise consultant about opportunities, typically you're going to have an initial call with the franchisor. If there's an agreement that you want to learn a little bit more, you want to roll up your sleeves and get some additional information. Just like on the existing business side, you might schedule a buyer-seller meeting to go in and meet the seller and ask them some questions. Well, you're going to have a conversation with the franchisor and learn a little bit more about their opportunity. They're going to send you their FDD, which stands for the franchise disclosure document. And that document is going to show you corporate financials. It's going to show you their executive team. It's going to break out the investment level. It's going to give you a list of every single franchisee that they have in their entire system. You're going to get your hands on that FDD document. And as a franchise consultant, we can help you navigate through that. If you've never looked at a document like that before, I take my clients through that document and help them understand what are some of the areas that they want to take a look at in there. Then you're going to have some follow-up calls with the franchisor. It's a process. You're going to get, dig deeper with each one of those calls with the franchisor. And then once you have a good foundation of that model and of the opportunity, they're going to open up validation calls. And that's the opportunity for you to really talk to other franchise owners out there who are doing this already and have already made the investment, and ask them some questions on how things are going, and ask them some questions on, thinking back to those key peers of what's a quality franchise company, the training, the support, the system, see what these people have to say. And as you talk to 2, 3, 10, 15 other owners, maybe all across the country, you're going to get real comfortable with how is this model, and how do they treat their franchisees. And then if that goes well, everything evolves towards a discovery day. And a discovery day could be virtual. It could be on site. We have had a lot of virtual discovery days over the course of the last year, where you get a chance to meet the executive team, ask them questions. They get a chance to spend some more time with you before you are in a position where you're going to make a final decision. This whole process could be anywhere from 4 weeks to 4 months, just depending on your time frame as you go through that process. Some key questions when you're talking to different franchise concepts is get a feel for the territory and how they are actually carved out. Get a feel for if it's a brick and mortar model, are they helping you negotiate and actually find spaces and sites that would meet their criteria? And then how long is that initial term? We talked a little bit about that. Is it a 5-year term? Is it a 10-year term? Do they have a franchise advisory committee? Talk to me a little bit about your training. How do you offer ongoing support to your franchisees? Really good questions to ask a franchisor as you're starting to get your arms around the opportunity. And then the big question that everybody wants to know, and they want to get, if you are a buyer who has taken the time to take a look at some existing, businesses for sale, you're used to taking a look at some financial statements. And all of a sudden now, if you start taking a look at doing a new franchise license, well, how the heck can you get a feel for the how much money can I make, question. And in the franchising world, you're able to get comfortable with that question 2 ways. The first is some of these franchise concepts are going to have a item 19 financial performance in their FDD document. Okay, an earnings claim in their document. Many of these franchise companies will have that in there that you'll be able to take a look at, again, once you've had that initial conversation and they disclose you and they send you their FDD document. And then the second one, and you can see I've put it in bold, is talking with other franchisees. When you get other owners on the phone, you can ask them, how did the ramp up go the first 12 months? What'd you do in revenue in 2020? How did COVID impact your business last year? What are you tracking towards in 2021? And what do the profit margins look like in this business? And as you're talking to these other franchisees, you're going to be taking some notes down based on those conversations. And again, remember, you could talk to as many of those franchisees that you would like to until you get comfortable or you don't get comfortable. You find out this really is not the right fit for me. So that's the beautiful thing about the franchise industry versus a business opportunity that you may come across. Is the franchising industry, they have to let you know all of the owners that they have underneath that model. And if there's a comfort level there, because these franchisees, I do these validation calls all the time. They tell you the good, the bad, and the in between, right? And it's a fantastic way to really get a feel for could you see yourself actually running this franchise and being involved with this particular group. Final thoughts on the franchise process is stay open-minded. That's one of our themes here on these Be Your Own Boss seminars is stay open-minded as you take a look at opportunities. I know Chris a lot of times will talk about expanding your area. Maybe you were initially thinking you live in Woodbury and you're just looking at business opportunities in Woodbury. Well, expand beyond that in the Twin Cities area. And we're in the Minneapolis submarketplace, but in that example, expand your area a little bit. You're going to be able to take a look at more opportunities. Maybe those opportunities could be relocated. Maybe they can't. But again, as you expand your horizons a little bit, you're going to be able to take a look at other options. And I say that with the franchising world too, is keep the options open. Don't close the door on the franchise. You may think if you have concerns, let's talk about them. And they're not for everybody. Franchise opportunities are not for everybody. But for a lot of individuals who come from corporate America and they've worked underneath some sort of a system and a support structure, they can be really good fits for that particular buyer. So stay open-minded, validate with existing franchisees and ask them questions about the systems, the training, and the support, and determine who the moneymakers are in the system. If you're going to invest your hard-earned money into a franchise model, You want to find out who are the top 20%. You want to talk to some of those individuals. You want to figure out what they're doing, and you want to be their best friends, because those are the individuals that you want to rub elbows with, spend time with at the annual conventions, because you want to figure out what they're doing in order to get to the top. And then follow the system. And there should be a huge star next to that. Is the system is there for a reason. They're giving you the tools. You're responsible, though, for executing that business model. Okay. The path is there. You got to follow the system. And if you follow the system, you reduce your risk. You put yourself in a good position to have some success with that particular franchise model. So with that, I'm just going to spend a couple minutes here clicking through a few slides on a couple franchise opportunities, just to give you a feel of some different models that you might not have even thought about when you think of the franchise industries that are out there and are looking to grow. You know, they're looking to grow across the United States right now. First one is the Pros Nails opportunity. If there are people on this call that have seen and heard of Massage Envy, well, the past president of Massage Envy rolled out the Pros Nails model. And in the health and beauty space, this probably is the last industry that has not been franchised. It's highly fragmented. There's 60,000 nail salons that are out there, and there's no national category leader. There's no national franchise. And that's what the Pros Nails model is looking to do. They are rolling out, just like Massage Envy did when they first launched that brand, they are rolling out a membership-based model. So individuals will have the opportunity to purchase a monthly membership, and that monthly membership dues will get you any combination of 3 different services. And let's say my wife purchases a membership and she only uses, let's say, 1 manicure for the month of April. Well, that membership, if we have a daughter, she can go in and also utilize the other 2 services during the course of that 30-day period. Okay. And they have different membership type models that individuals can select from, but that's their niche. That's a huge differentiator in this space. And their leadership team comes with lots of franchise experience from Massage Envy. I mentioned that. Orange Theory, they work with the same marketing program that Orange Theory Fitness utilizes. And that core focus is a pre-sales focus. So before your location is even open, you are pre-selling Pioneer memberships to the first 100 at a certain level, and then the next 100 at another level. And those are obviously going to be discounted membership dues. But what that allows you to do is really increase your cash flow time frame. You already are having revenue coming into your business, and your doors aren't even open yet. So it's a boutique in terms of style and size. You're usually at around 1,500 square feet for these salons. They're going to have 25 of these open throughout the country by the end of this year. Total investment's about $400,000 all in. That includes some working capital. That includes the franchise fee, as well as the customization of the space. This model does have local regional developers. So in addition to having a corporate support team, you also have a local regional developer who can help you in your marketplace find the right site, get it open, do localized marketing to drive traffic, so you get that extra layer of support if there is a regional developer already in your market for the pros concepts. The next concept is Pet Evolution. This is a new model, and you think of one industry, and I know personally, whether it's neighbors or friends or family, in this last year when people are spending more time at home, there has been a lot of households who brought in a new member of the family, dogs, cats, coming into the homes. And Pet Evolution is a wellness retail-based franchise that really caters towards dogs and cats. And you look at 67% of the U.S. households have and own a pet. and they're members of the family. If you own a pet, you can nod your head and agree that you're spending money on food and toys, and treats, for the pet. And so this is an industry where people are spending money on their pets. Why is Pet Evolution different? So this is a boutique type. Setup as well, where they offer retail products and food, and they also offer grooming, dog grooming on site. And then over here on the right hand side of the slide, they offer self-serve dog washing stations where people can come in and they can self-serve. They can dog wash, or they could have somebody there wash their dogs. And they've also tied in a membership component to this Pet Evolution model, where you can pay a monthly fee and have unlimited dog washes every single month. So another way that they tied in that membership, which is fantastic from a cash flow and a revenue standpoint with your business. They have a mobile nail trimming van that goes out and can trim nails on site. And they do a number of different community outreach type programs with Pet Evolution. Pet Evolution currently, they are offering regional development licenses as well as single territory licenses. So if you have a passion for pets, this could be an opportunity that you could take a look at, whether it's a single territory or you want to tie up a large market and again, almost become a mini franchisor in your particular space. Total investment, about $500,000 all in, $49,000 franchise fee. So again, in your mind, when you're thinking through if it's a $500,000 investment and you were to go the SBA route, the banks are going to look for, probably somewhere between $75,000 and $125,000 of your equity, and then you do an SBA loan for the balance if that was a route that you were going to go down. The last model is we've had a lot of activity in the home service sector in the franchise world in the last year. Again, people are spending more times in their homes. They are fixing them up. They're renovating them. Maybe they're putting an addition on. They're doing landscaping in their yard. So we've had a lot of interest in the service sector for around the home in the franchise industry. And there are lots of quality franchisors out there that are doing really well in this space. FiberNew is an expert in leather, plastic, and vinyl restoration. You can see all the awards that they've received over the years. And these are based off of even what franchisees or existing franchisees are saying. Very positive feedback from their existing franchisee base. It's a mobile operation, does not require brick and mortar. Mobile operation, technicians show up in a van on site and do the work on site. So you've got flexibility to set your own hours. You're not tied to a lease and have a lease payment, completely mobile operation. The value proposition with FiberNew, there's a couple things here. The first is the quick turnaround. If you've got the leather chair at home that the kids have put their feet up all the time or rubbed it raw, they can come in and fix it, make it look brand new, and turn that around in a couple hours in your home. It's a cost avoid. Instead of going out and having to purchase a brand new sofa or chair or ottoman, you can just you can have your restored for much less money, a smaller investment instead of purchasing brand new. And then there's a green play, an eco-friendly play with this space is keeps items out of landfills. Instead of having to always go buy new, well, you can restore. Multiple different markets with this FiberNew model. There's the commercial play with office buildings and medical facilities and I have a couple pictures here I'll be able to show you guys, the marine boats and yachts, cars, and again, the residential. So you've got multiple different markets that franchisees can decide to maybe focus in on one or two if they really have a passion for that space, or they can work across all those different markets. Here's just a couple screenshots of residential furniture. You can see your son is a big Toronto Leaf fan and does a little graffiti on your chair, and you come home one day. Well, you can see the type of quality of work that FiberNew is doing. I've seen the quality of work firsthand. The owner of this company used to be a franchisor. He initially purchased a franchise license, and he came back and he bought the whole franchise. And he's now running the show. But you can see just a few shots from a residential standpoint. From a vehicle standpoint, you know, your leather interior of your vehicle gets worn over time, can make it look like it's brand new. Medical facilities, you think of those beds as just a simple example. Again,
hey, for those of you who are still there, we lost connection right there at the end in John's second or last slide, so we apologize. I see there's a couple of you still on, but you got all except the last 1 or 2 slides. We will send out the full presentation to all the attendees and maybe even add a little bit to the recording so we give you a link. So we apologize for that little technical glitch there at the end. We appreciate you joining us. And if you do have remaining questions, please feel free to put those in the Q&A or even email us at web@sunbeltmidwest.com and let us know it's related to the Be Your Own Boss webinar. And John, I just want to thank you all for joining us tonight. We had great attendance. Sorry about the little glitch at the end, but we hope it was useful for you. Thank you, everybody.